shift focus to Viceroy Research, because that is the sort of the joker in the pack right now. And actually, I'm joined by Fraser Perring, who's a co-founder of Viceroy Research, who's currently joining in from London. Fraser, my first question to you is that you've spoken about this bait and switch model of borrowing in Vedanta Group. I wanted to get a sense of, what specifically has happened in this, in your view.
Well, the amount of the bait and switch that you've got, we covered it very well. They are consistently announcing very catchy projects in the multi-billion US dollar mark. And they never come to much, whether it's semiconductors, glass manufacturing, or nuclear power. And if you actually go through a lot of them, their delivery, the ability to deliver them, is few and far between. And it's always over-promise and under-deliver. But they use that period in which they can raise capital and divert it to just sustain the dividend flow through to VRL. And people, if you made a list historically of how this has gone and what's been achieved, after every spinning plate exercise of look what we're doing, there's a capital raise or a bond raise, and then all of a sudden it's forgotten about. It suddenly disappears a few years down the line.
All right, Fraser, you've also referred to Capex fraud in your report. If you can just tell us a little bit about what exactly it is that you're seeing in terms of Capex fraud here in the Vedanta Group.
But the expenses that they are actually utilizing or maintaining aren't compliant with audit rules. And when they're saying it's a Capex expense, it's generally to pay something else, a fine, or there's a going concern issue. And they have prioritized that, even with the expansion of the steel plant, ESL, 300 million expansion. But if you actually have a look at what it was spent on, trees.
Interesting. Trees. Okay, I wanted to ask you a question about a statement that you made in your report, which is saying that the actual debt of this group is valued much higher than the reported debt. Now, of course, that detrimental little company. But how are you reaching this conclusion?
Well, it's the interest cost. The interest expense, we took the company figures of net and gross interest, and we looked at the cost comparison versus the disclosed average of that, the cost of that debt, and the two don't meet. And it could be that they're doing intercompany, not intercompany, inter-period borrowing. But the reality is that they've, as a group, per se, they're saying that they're deleveraging, whereas in reality, it's nowhere near what they say. But they want to cherry pick the good bits while ignoring where it's being transferred to. And that continues a theme which jeopardizes legitimate projects, where when they are using the debt to pay a dividend that's completely underfunded, they're also starving projects that could do with genuine capital expansion. And that's further rolled on the delays and the inevitable promise and headline grabbing.
Right, Fraser, one of the arguments that the company gave was the fact that Viceroy Research has never reached out to the company. Firstly, I just want to ask you, did you reach out and did you actually need to reach out? I just wanted to get a sense of this act of reaching out before releasing the report. Would that have changed the outcome in any way?
Why would it affect the outcome when if a company, particularly with their shall we say, very predictable response. The only criticism they've got is that we didn't reach out. All the information, as they've rightly said, is public, but they don't want people to go digging for it. So if we'd have come to the same conclusion but reached out to them, all they're going to say is, like they've done today, it's misleading and wrong or malice. Whereas in reality, investors, the minority shareholders and stakeholders, need good answers to what we've uncovered. It's unacceptable that the minorities, including the Indian government as a stakeholder in Hindustani Zinc, are being damaged for the benefit of VRL. And likewise, if we reach out, what is going to change about their interest costs? Everything should be in their accounts. We've relied on their information, and we've gone digging for local subsidiary accounts. At no point was there a disclosure, even on ESL, which we've just spoken about, where there was 3 years of it was spent buying land and trees to offset environmental issues. The transparency of Vedanta is significantly in doubt. It's selective at best and misleading or misrepresentative of exactly where things are. But they've had a shortfall for what they've paid out for a number of years. And they're continuing a strategy at the end of the day that all the other stakeholders are going to be damaged for. And that needs accountability. And we'll be making submissions to SEBI on that, specifically around the violations that we believe that have taken place. And they're significant.
Right, Fraser, short sellers tend to get a bad name in India specifically. You've said that you are short of the entire Vedanta Group debt stack. I just wanted to get a sense about how you defend your position while making these allegations against the Vedanta Group.
Is that not the same as analysts with clients that are long? We aren't with the defense is, there's our thesis. This is our opinion, and we believe that this isn't fully known to the market. And short sellers, I don't think are appreciated as much as they should be for the level of detail they go to. The historic results of short sellers, even Viceroys, speak for themselves. We've been short companies that have been in India before, including Ebix. That went bankrupt. And it's not a new phenomenon, but you should embrace it objectively. People have written into Viceroy and said, have you thought about this? And we've explained our thinking. They go, oh, I didn't see that. That is a healthy market participant. We aren't saying that everything that Vedanta respond with will be lies, but is often the case with many of the companies that we have focused on and other short sellers. They refuse to admit their shortcomings until it's too late. And we saw that in Sweden, where they continued to pay dividends until they'd almost collapsed the entire company. And it took a management change. Adler in Germany came out with this almost identical responses to what Vedanta did, and they were trading at, I think, 40 euros. They're now down at 40 cents. But there was nothing to see here. I would encourage people, even if you don't like short sellers, to actually just go away and fact check them. Don't believe us, but don't believe management, and come to your own conclusions. And that way, at least, you can make an informed opinion. We aren't like a banking analyst that says, there was one announced, I can't remember his name, 5 minutes after our report came out, 80 odd pages, nothing new here. And most people won't comprehend the full impact of our report until multiple reads. But within 5 minutes, 80 odd pages, nothing new here. If there's nothing new, why hasn't he highlighted these risks within his analysis? Because it doesn't meet the status quo. And it's a flagrant abuse of the access to management. We don't need to speak to management because all their data's there. It's very easy to delineate and explore the issues, but analysts don't want to do a deep dive. They listen to management, they replicate it, they're very bullish. Some do a bit more work and are a bit more conservative, and you get the odd outlier that's willing to come out and go, I'm sorry, this is rubbish. But on the whole, a company should be held to account just like we are with our work. If we find a mistake in our report, as we've done in the past, where it's, even if it hasn't had material issues or influence in our thesis, we've still highlighted the mistake and corrected it. But the companies aren't accountable, and everything they say is obviously true, and short sellers are lying. Companies prey on the prejudice the market has to short sellers. And the only people that get harmed in the end, as many shareholders in Sweden, Germany, the US, and the like have found out, their detriment is in listening to the management and not being objective. And I'll give you an example in Home REIT in the UK that we were short. It was all lies, defamatory, false, and misleading. The company has been suspended for so long, I suspect the shares are nearly worthless. And they finally come out and admit there's issues. A year and a half after calling us and all sort of negative short-selling words, pointing out exactly what Vedanta did. And now all of a sudden they're dealing with the crisis and their own liability.
Right, Fraser, thank you for that detailed response. Now, I want to ask you one last question, which is that there are recent revelations that have come out in an interim report by SEBI about alleged market manipulation by Jane Street. You know, of course, this is an interim report and a final report is still awaited. But do you think that an investor who may give your report a chance and read it in full could be unduly biased about your intentions because of the prevailing conditions of the market?
I think I can't speak for Jane Street, and as you say, the report isn't out there, but the media of what I've read suggests that there was some short-term manipulation between the equity and the options or similar. And you can check our record, we aren't short-term. We publish it, we aren't. People can make up their own minds, and if they don't agree, they can voice their opinion like we have a right to voice. But the correlation between Jane Street, which maybe it was high frequency trading or similar, is very different to an in-depth report where we outline our thesis. We aren't just trading on differentials, and we certainly aren't here short term.
All right, Fraser, thank you so much for joining us on this conversation. It's truly been a pleasure talking to you. Of course, that was Fraser Perring. He's a co-founder of Viceroy Research.